Imagine, for just a second, that you own a home. Like you've been diligently paying your mortgage for
Yeah.
years. You're building a life there, maybe raising a family.
Yeah, you got real roots in the place.
Exactly. You effectively own, say, 70% of the property.
Yeah.
But then a sudden life crisis hits. You lose a job or a business deal goes sideways.
Which, I mean, happens all the time.
Right. So you miss a few payments and you come home one day and there is a heavy metal padlock placed on your front door by the bank.
Oh, man, it's such a brutal visual.
It really is. You own the vast majority of this house, yet you are locked out on the street. Today we're doing a custom deep dive into a stack of sources that tackle this exact nightmare scenario. We're going to explore a proposed framework that could totally change how the world handles secured debt.
Yeah, we're looking at a really fascinating intersection of sources today. First off, we have a formal academic paper published in June 2025. It's titled Global Home Theory and authored by Prabhat Kumar. Alongside that, we have a deeply emotional essay he published on Father's Day, also in 2025. And finally, a really compelling stack of letters sent in July 2025 to the absolute highest government and judicial officials in India.
So the mission of this deep dive is to unpack how our current mortgage and banking systems actually handle financial distress,
Yep.
right? And to figure out why they seem so incredibly rigid.
Precisely. And more importantly, we're exploring Kumar's global home theory, which basically proposes prioritizing human dignity and actual equity over strict algorithmic financial protocols.
I love that. And for you listening, I want to frame this up front. This isn't just some dry theoretical discussion about banking regulations. This is the gripping story of a single citizen taking a massive personal trauma and actively trying to change national law.
It's an incredible story. And to really understand the theory, we have to look at the human catalyst behind it. The academic paper didn't just emerge from a vacuum.
Right.
It was forged in a very specific, devastating sequence of events. So back in 2020, Prabhat was working at MBB Labs.
That's a subsidiary of Maybank out of Malaysia, right?
Yeah, exactly. And he received this massive corporate incentive, like a life-changing bonus. He took that capital and decided to invest in a luxury Pravenkara flat in North Bangalore.
Which makes sense. He viewed this as planting the flag for his future. And for a while, everything was tracking perfectly.
Oh, yeah. He was doing so well that he actually left the safety of his corporate job to leap into entrepreneurship.
The dream.
Right. He started an edtech venture called ML360 Educations. The whole goal there was to democratize artificial intelligence and machine learning.
Making those subjects accessible to everyday people, not just, elite engineers.
Exactly. And he built a really solid reputation doing it. He was pulling a 4.7 out of 5 on Trustpilot.
Wow. That is not easy to do.
No, it's not. But the reality of entrepreneurship is that it exposes you to immense volatility. The sources detail a really severe setback. Prabhat was defrauded of 20 lakh rupees by his partners.
20 lakhs. Oh, man.
Yeah. The documents specifically name Edurika and a mentor named Rajat Singha in this betrayal. And that kind of financial hit creates an immediate, severe cash flow crisis for a startup founder.
Oh, without a doubt. And the timing, it couldn't have been worse. Right as that fraud basically drained his operational capital, he hit a massive wall with his property.
Yeah, the flat.
Right, to officially register the flat, he suddenly needed another 30 lakhs. He felt some of those required amounts were overcharges, like things that could be legally challenged, but the deadline was looming.
He had to pay to secure the asset.
Exactly. He reached out to friends, and they just vanished. It was his senior citizen father who ultimately stepped in to pay that 30 lakh registration fee.
And that Father's Day essay provides such incredible insight into that specific moment. His father didn't just, hand over the money blindly.
Right.
He offered a very pragmatic piece of financial philosophy. He told Prabhat that if the cash flow crisis meant he couldn't sustain the EMIs, the equated monthly installments for the loan, he should sell the flat.
But not in a panic.
Exactly. He was adamant that Prabhat shouldn't sell it at a loss. The property's market value had actually appreciated to 1.68 crore rupees.
Wow.
Yeah, so his father advised him to sell it at that true market value to protect his future if it came down to it.
Which, makes perfect mathematical sense. By this point, between his initial payments, the registration, and the property's massive appreciation, Prabhat already owned roughly 60 to 70% of the flat's total value.
He had massive real equity.
Huge equity. And he wasn't just sitting around either. He was actively exploring ways to recover his cash flow. He was taking on faculty positions while waiting for outstanding payments that were owed to him by government institutions.
Yeah, like the VMU Institute of Technology.
Right. So he has money coming in eventually,
Yeah.
but his lender, L&T Finance, they did not care about that timeline at all.
Not one bit. They moved with absolute severity. Despite his massive equity stake and despite his clear intent and efforts to resolve the cash flow gap, the lender just locked the flat.
Just like that.
Just like that. They put up a forced sale notice without any consultation or mediation whatsoever.
Okay, let's unpack this because I want to put this into an analogy to really highlight the absurdity here. It is like buying a 10-slice pizza.
Yeah, I'm with you.
You pay for and eat 7 slices. But then you realize you're short on the tip for the last slice. And the restaurant just comes over and takes the entire box away.
That is exactly what it feels like.
How does a bank justify locking a citizen out of a 1.68 crore asset that they mostly own?
Well, the harsh reality is that Prabhat isn't the only one getting locked out. This is a feature of the system, not a bug. To understand why the bank acted so ruthlessly, we really have to look at the legal and financial safety nets they are operating under.
Right, the system itself.
Exactly. The academic paper dives deep into the mechanics of this. It identifies a phenomenon it calls the equity trap.
Okay, I want to break down this equity trap because it relies on how mortgages are fundamentally structured. Most people have amortized loans.
Yes, standard mortgages.
Right. So if I understand the math correctly, in the first 10 to 15 years of a typical 30-year mortgage, my monthly payment is heavily skewed toward paying off the bank's interest, right? I am barely touching the principal loan amount at the beginning.
That is the exact mechanism. You are front-loading the bank's profit. So over those first 10 to 15 years, you build substantial equity upwards of 60% of the home's value.
Because I've been paying faithfully for a decade.
Exactly. You have already paid the lender a vast sum of interest. But the equity trap snaps shut if a short-term crisis hits. If you miss just 3 to 6 months of EMIs, the bank can reclassify your entire loan as a non-performing asset or an NPA.
Just 3 months.
Yeah. And in India, the trigger for that trap is governed by a specific law, the SARFAESI Act of 2002.
Right. I was reading about this. Looking at this legislation, it grants staggering power to financial institutions. I mean, it allows banks unilateral authority to classify a loan as an NPA after just 90 days of default.
Just 90 days.
And then they can demand total repayment or threaten repossession within 60 days. And they don't even need prior court approval to initiate this process.
It's wild. The paper actually gives a name to this phenomenon: inhumane efficiency. The current system treats the family home purely as a liquid asset subject to maximal recovery.
So they don't treat it like human shelter at all.
Not at all. When the default is triggered, they don't just politely ask for the 3 missed payments. They add penal interest, bounce charges, legal fees. They pile on punitive debt to maximize their recovery.
Wait, let me play devil's advocate here for a second, because I have to look at this from the institutional side too. If a bank doesn't strictly enforce defaults, doesn't the entire financial system risk collapse?
That's the classic counter-argument, yes.
Because banks aren't charities,
Yeah.
right? They are managing huge risk pools. If they let people slide on payments for months or years, the bank loses its own liquidity, and then no one gets a loan to buy a house in the first place.
Yeah.
So why would lawmakers hand banks this, like, bulldozer of a law in the first place?
It's a fair point, and the historical context of the SARFAESI Act actually answers that question perfectly. See, back in the late 1990s and early 2000s, the Indian banking sector was choking on massive bad loans.
Like Newtel loans.
No, mostly from large industrial and corporate defaults. The traditional civil courts were way too sluggish. It was taking years to resolve disputes. So the SARFAESI Act was enacted to bypass the courts and allow banks to swiftly recover funds just to keep the economy afloat.
Oh, okay.
Because regulators and central banks require retail banks to maintain strict liquidity ratios.
Meaning they have to keep a certain amount of cash on hand to prove they are solvent?
Correct. It's a concept called provisioning. When a borrower's loan stops generating cash and becomes an NPA, the bank is legally forced by the regulator to set aside its own capital to cover that bad debt.
Which completely locks up the bank's money.
Exactly. So the algorithm demands that the bank quickly liquidate the asset to free up its own capital. They foreclose because of regulatory pressure, not necessarily out of malice.
Okay, that makes the mechanics clear. But it also highlights the massive flaw Prabhat is pointing out. That regulatory bulldozer was built for massive corporate defaults. And now it's being driven straight through the front doors of single-family homes.
That is the exact problem.
And here is where the global home theory pushes back on the bank's logic. The theory argues that seizing a collateralized, appreciating asset for a short-term cash flow gap is actually financially counterintuitive for the lender.
There is a really strong mathematical reason for that pushback, too. Real estate, especially in growing urban centers, generally appreciates over time.
Right.
If a borrower has 60% equity in a property that is gaining value, the bank's actual risk of losing their initial capital is incredibly low. Plus, foreclosure is an expensive process.
Oh, I bet.
It involves litigation costs, administrative overhead, and properties sold at auction often fetch well below market prices.
So the bank might actually lose money, or at least leave a ton of money on the table by rushing to foreclose, compared to just working with the borrower.
They absolutely do. The paper argues that by rushing to repossess, the bank ignores the borrower's moral intent to repay. They treat a secured, appreciating asset the exact same way they treat an unsecured, defaulted credit card.
Which is crazy.
It is, and in doing so, they destroy a customer relationship that could be highly profitable over the next 20 years.
Okay, so this transitions us perfectly into the solutions.
Yeah.
Because the global home theory doesn't just complain about the break-in system. It offers a completely new set of mechanics to fix this without breaking the banks or violating those liquidity requirements.
Right.
The first major pillar of GHT is that intent matters.
Yes. Currently, financial institutions treat all defaults through the same binary lens. GHT argues that lenders must distinguish between, say, a speculative investor who parked money in 5 different properties and a family residing in their primary home.
Sending their kids to local schools, paying local taxes.
Exactly. If you live there, the societal stakes are totally different.
Makes total sense. The second big proposal is a refined NPA classification, and this is tied directly to the equity trap we just discussed. Under GHT, if a borrower has built up over 50% equity in their home, the property should not be automatically labeled an NPA just because of a temporary disruption.
Because reaching that 50% equity threshold proves historical financial discipline.
Right.
It proves you aren't a flight risk. So instead of the algorithm automatically triggering a foreclosure, the theory mandates the use of loan relief options.
What does that look like in practice?
Well, it means the bank would be required to offer things like EMI holidays, literally a temporary pause on payments, or they could extend the tenure of the loan, temporarily adjust interest rates, or offer moratoriums without stacking on those compounding penal charges.
It essentially provides a breathable runway for the homeowner to recover their cash flow.
Exactly.
And, okay, my favorite part of the paper is the proposed systemic solution called home security covers. It works like this. When you get your mortgage, you pay a nominal premium, almost like an insurance policy.
Right.
If you lose your job or face a verifiable crisis, that cover kicks in and pays your EMI for 6 to 12 months. It's essentially Apple Care for your mortgage.
Love that analogy. You buy the protection up front, so if the machine of your life temporarily breaks down, both you and the bank are protected.
It's brilliant.
It really shifts the entire psychology of mortgage lending from reactive punishment to proactive protection. And for cases that are more complex or disputed, GHT proposes the creation of a Home Equity Retention Tribunal, or HERT.
Okay, a tribunal.
Yeah, this would be an independent body designed to resolve these specific disputes on a case-by-case basis. They would look at humanitarian grounds, verify the equity status, and mediate a solution, rather than the bank just rubber stamping a blanket foreclosure order.
And linking back to the bank's financial incentives, GHT highlights that retaining the customer is the ultimate win here. If a bank helps a family keep their house through a 6-month rough patch, they save on option costs, and that family is going to remain a loyal, interest-paying customer for the rest of their lives.
It advocates for mutual accountability and shared risk. The old lender-first recovery model is just outdated when we have the data to manage risk more intelligently.
Okay, so we have the human trauma of the lockout, which birthed this incredibly robust academic framework. But a theory published in a journal is just, ink on paper until someone forces the issue in the real world.
Very true.
That brings us to the summer of 2025. Prabhat didn't just write a paper and move on. He orchestrated a highly targeted campaign to actually change the law.
He really did. On July 19, 2025, he sent a series of incredibly detailed letters to the highest echelons of the Indian government and judiciary.
Who are we talking about here?
The recipient list is formidable. He wrote directly to the Chief Justice of India, the Ministry of Law and Justice, the Attorney General, and the Solicitor General.
Wow. And he didn't stop at the executive and judicial branches either.
Mm.
He also wrote to the legislative branch. Specifically, he targeted the Parliamentary Committee on Law and Justice and individual members of Parliament who carry immense legal weight.
Yeah, senior advocates like Kapil Sibal and Dr. Abhishek Manu Singhvi.
He is going after the people who literally write, debate, and interpret the laws of the country.
Exactly. And the core request in these letters is remarkably focused. He is not asking for a taxpayer bailout.
Right. He doesn't want free money.
No. He is asking for a simple legal check to be amended into the SARFAESI Act. He wants a mandate requiring lenders to objectively assess the borrower's equity stake before they are legally allowed to initiate foreclosure.
Let's translate what that means for the legal system. The expert sources note that Prabhat wants to introduce a contextual morality clause. For anyone not fluent in legal theory, here is an ELI 5 and Explain on 5 translation.
Go for it.
Under the current law, the system operates on a binary. You either paid on time or you didn't. 1 or 0. So instead of banking algorithm just seeing a missed payment and automatically spitting out a foreclosure notice, contextual morality means a human or more advanced system has to pause.
Right.
They have to say, wait, this person has paid flawlessly for 10 years, they hold 60% equity, and their industry just experienced mass layoffs. Let's give them a 6-month pause instead of taking their house.
It's so rational. It is about demanding that our legal frameworks evolve to match the complexity of modern life. We operate in an economy defined by job volatility, sudden industry shifts, global economic shocks. A binary default system is just an archaic tool.
Totally.
If someone has a decade of flawless financial discipline, a temporary life disruption should not erase that history and vaporize their accrued wealth overnight.
I want to clarify for the listener, we are not taking sides on Indian law here. We are just impartially reporting on how one citizen is petitioning his government to change the balance of power. But the philosophy here is undeniable. It attempts to move the concept of a home away from pure asset commodification.
Exactly. It recognizes housing as a fundamental human necessity that requires a more nuanced approach than, say, liquidating a stock portfolio on a trading app.
A house is shelter before it is collateral.
The global home theory is just asking lawmakers to bake judicial review and basic human empathy into the mathematical formulas of banking.
It is an incredible journey to trace. I mean, we started with an entrepreneur who suffered a severe financial betrayal. He found his 1.68 crore apartment locked by a bank, despite owning the vast majority of it.
A literal padlock on the door.
Right. But instead of just walking away or accepting the loss, he internalized his father's advice to protect his future. He did that by meticulously drafting the global home theory, and then he took that theory and dropped it directly onto the desks of the most powerful lawmakers and judges in his country.
Challenging them to reform a decades-old banking law. He managed to turn a profound personal displacement into a highly structured campaign for systemic social justice within the mortgage lending industry.
This entire deep dive really forces a shift in how we view our own finances. The next time you pay your mortgage bill or whatever EMI you might have, don't just look at the remaining debt balance. Think about the equity you hold.
Think about the massive value you have steadily built over the years.
And crucially, consider how legally vulnerable that value might be under your current national banking systems if a sudden, unexpected shock were to disrupt your cash flow.
It's a sobering thought.
It is. Which leaves us with a final provocative thought for you to mull over. Right now, modern banking systems utilize incredibly complex AI and algorithms to instantly calculate our risk profiles, right?
Oh, absolutely. They have so much data on us.
They use this cutting-edge technology to predict defaults and protect their own liquidity. But if the technology is already that sophisticated, why couldn't that exact same AI be trained to predict temporary human hardships?
Oh, wow. That's a great point.
Imagine an algorithm that monitors macroeconomic data, sees a sudden wave of job losses in your specific sector, recognizes that you have crossed that 50% equity threshold, and automatically triggers the exact EMI, holiday, or loan restructuring you need before a default is ever officially recorded.
That would be the ultimate realization of Prabhat Kumar's vision. Technology and data being deployed not to execute a punitive foreclosure, but to proactively protect the citizen.
A financial system designed to recognize your inherent worth and historical discipline, rather than just fixating on your momentary debt. So that when the inevitable crisis hits, instead of sending an agent with a heavy metal padlock to bolt your front door, the bank sends you a safety net.